to get into a detailed analysis. So the cost of equity, first of all, at zero debt, how do you come up with this? Since the firm has zero growth, its current value of 2 million is given by this formula. Where did the 2 million come from? The 2 million came from, this was your $20 share price multiplied by 100,000 shares outstanding. So the value of your total company is 2 million. Now this, remember your cash flow, this is zero debt. So any interest payments? No. And we said all the earnings are paid out as dividends. What were the earnings? It was 500,000. What was the tax rate? 40%. So how much dividend every year do the shareholders get? 300,000. So 500,000 minus the tax of 40%. So that's 300,000. The value of a company is equal to the dividends divided by the cost of equity. This is your perpetuity formula. The present value of a constant of a perpetuity is the cash flow, which is 300,000, divided by the cost of equity. So what's your cost of equity? You do your cost of equity, that is 15%. So this is the unlevered cost of equity. Why are we calling this the unlevered cost of equity? There is no leverage. Now given this, can you calculate the beta of an unleveraged company? You can, using CAPM. So your CAPM said that the cost of equity is equal to the risk-free rate, which we said was 6%, plus the beta multiplied by the risk premium, which was 4. Using basic algebra, you can figure out that B is equal to 2.25. So notice here you have already used material from your basic time value of money, which was perpetuity, and now you've also used money from your earlier reading on CAPM. So you've come up with your beta. Okay. Now what we are going to do is look at different levels of debt and look at the beta and the cost of equity at different levels of debt. So when debt is 0, do you know where this 2.25 came from? This is what we just did. So, and where did the 15% come from? We just did that. So on the previous slide, we did a basic working for a company with 0 debt. Okay. Now what if the debt is 250 million? Remember, what was the value of equity initially? It was 2 million. Now if you recapitalize and you reduce equity by 250,000 and increase debt from 0 to 250,000, what is the debt to equity ratio? What I want you to do is do your calculation and come up with, see where this number came from, see where this number came from, and see where this number came from. So do these calculations. I'll just show you the previous slide real quick. Okay, so that's the CAPM formula. Now you need to, so the debt to equity, you simply did 200, as in from 2 million you subtracted 250 actually, because that's the debt, and then so the debt is 250 divided by by the equity amount minus the debt amount. Okay. How did you come up with beta leverage of 2.44? Yeah, using the formula that's staring at you, right? So you don't need the previous slide for that. And then how do you think you come up with KS? Exactly. And if you don't know CAPM, then I don't know, then you shouldn't be here. All right. So So then has everybody done all three then? Alright. So, okay, so did everybody get 15.77 also? This is based on CAPM. This is based on Hamada, and the 0.142, this is debt of 250 divided by 2 million minus, so this is 250,000, 2 million minus 250,000. So this is 0.12, 2.44 again Hamada, and KS is CAPM. So now do we need to do the rest, or can you believe that the numbers here are correct? Okay, you believe, alright. So you've understood where this table came from. Okay, are we ready to move on? Alright. So now let's look at the impact on the stock price. Okay, what do we have so far? We have the cost of equity at various levels of debt. Does it make sense that cost of equity is going up as the level of debt is going up? Yeah, the firm is becoming more risky, so the cost of equity is going up. What do you think we'll do next? We are going to find the value of the stock and then the value of the firm at different levels of debt. What was the value of the firm? So when debt was equal to 0, then what was the value of stock? It was 2 million. So value of stock was 20, the total value. When we are saying value of the stock right now, we mean the total value. So this was 2 million. Now what have we done? We've taken debt worth 250. If we take on debt worth 250, we are told, where did this KD equals 10% come from? This is 10% interest. This was given to you. Where did this come from? You just calculated it based on CAPM. You calculated beta L, and then you used CAPM to come up with this number. Okay, now how will you, Basit, come up with the value of the firm? The value of equity. What's the formula? How do you come up with the total value of the stock? Yeah, so what's the logic of this formula? This formula that I'm pointing at, this one, yeah, the one I'm pointing at. Okay, so what's the logic of this formula? Aisha, of what? Total amount of what cost is this giving us? Yeah, so this is the interest. So the stock amount, what is the cash flow available to the common shareholders? In other words, what's the dividend? The dividend that you get, do you get it after paying interest? Yeah, so after paying interest and taxes, what you get is what the dividend that you get. So this is EBIT, earnings before interest and taxes. How much was this? 500,000, 500,000. So from that you are subtracting this is the subtraction of the interest, and then what do you subtract after that? You are subtracting taxes. So now is this numerator the cash flow every year that stockholders get? Then how do you figure out the total value? You do this is a perpetuity, right? So this is the cash flow that they are getting every year, divided by what? Cost of equity. Now is this the same 15% that you used earlier, or will it be a new cost of equity based on it will be the new one, because we are in a new world where the cost of equity has gone up. Why did it go up, Saira? Exactly, you have more debt in your capital structure, so KS has gone up. So do you see what's happening here? What is this number representing? Yeah, so this is the value of stock, but now you also have debt. Is this value of stock less than the value of stock before? Yeah, but and also you have actually, this assumption is you bought back. So anyway, so this is the value of stock. So what's the total value of the company? Yeah, so it's 1807 is the value of stock, plus the value of debt, plus at this stage in our analysis we have not bought back the shares yet. We'll do that on the next slide. Okay, what have we done so far? We have raised money. So the other way of thinking of this is that debt 250 is actual cash that you currently have, right? So when you have that cash, so what is the value per share? So the total value of the company right now is 20. The value of the company has gone up. Brilliant. No. So you are hung up with Modigliani and Miller's first theory. We have moved on, right? So we are now actually past Modigliani and Miller. So we are now saying that at small levels of debt, the benefit of taking on debt is more than the cost of taking on debt. So that is evidenced by the fact that the value of the company has gone up. And what happens to the share price? The share price goes up. So was this a good move? It was a good move. The price of the share has gone up. Then we have just raised 250 million. We are using that 250 million to buy back shares. The share price is now this. So how many shares do we buy back? So remember, this was actually 250,000. So the number of shares that we buy back is 12150. So this is the number of shares that we buy back. So how many shares do we have left outstanding? So initially we had 100,000 minus this. So we now have 87850 shares outstanding. So notice that the money raised through debt, 250,000, is being used to buy back shares. So we have fewer shares outstanding. And if you still do a check on the stock price, your value of the stock is the same. Okay, now next we will look at the value of equity in 5 minutes. Value of equity at each debt level. So what's the value of the equity value at each debt level? It's going to be the dividends paid to shareholders divided by the cost of equity. So does this first row look familiar? These were the dividends, this was the cost of equity. The retention ratio is 0. Good, you retained that. Okay, so the retention ratio is 0, so the growth rate is 0. So we are assuming, since there are enough things to absorb here, we have made this model relatively easy by making a 0 growth assumption. Do you think you can go back home and make this problem more complicated and assume a 3% growth rate? You could if you wanted to. Okay, so you do that for homework. All right. Then next, when you took on debt of 250, the cost of debt was 10%. Where did this number come from? We just calculated it. So we said the dividend after paying out interest and paying out taxes. Where did this number come from? We just calculated this using first Hamada to come up with beta leveraged, and then CAPM to come up with this. And then where did this come from? It was the dividend divided by this, which we also just did. Now, do you think we can use the same procedure for the others? Should we do it, or would you believe that these are the right numbers? You can believe, but you can go back home and verify, okay, as practice, because you will see this on your exam. So you better know how to do this. All right. Okay, that's one way of making sure that you actually do this. Okay, and then, you know, in general, another lesson in life is when people say something to you, rather than arguing, you can just believe but then verify. Okay, so that is a graceful way of living life. Okay, so next is, what's the total value of the firm? What's the total value of a firm? So with 0 debt, what was the value of equity? So we are talking in numbers, so 2,000 times 1,000, 2 million. So the total value was this, and the share price was this. Then we moved on and took on debt worth 250,000. So what did equity came down? Is this number familiar? Then the total value, where is this coming from? It's the sum of debt and equity, and we calculated our share price. So was this a good move, going from 0, increasing debt? Share price went up. Then we said, okay, taking on debt increased our value, so as diligent managers who want to increase the value of the firm even further, what should you do? Take on more debt. So you took on more debt, and you are believing me so far, which might be a decent strategy. Okay, you come up with a new value of equity. What's the total value of the firm? So this, actually that Umar. What's the value of the firm at the value that we are talking about right now? Okay, either you do like the other Umar and make it explicit that you are not paying attention, okay, or you pay attention, okay. So like I wouldn't even bother this guy. Okay, so the total value is this. So what is this then? Has it gone up further? Is that good news? Okay, so when you see good news, what do? You try to get more good news. So what do you do next? You take on more debt. Yeah, but at what point? Okay, so you just want to see what happens if you take on more debt. Now when you take on more debt, what's happening? What's happening is the total value coming down now? Yes. Yeah, so the total value is then coming down. So have you identified your optimal capital structure? Yeah, what you have done is identified your optimal capital structure. So what's your optimal capital structure? Yeah, so your optimal capital structure involves taking 500,000 in debt. Okay, so do you notice we've done so much over here? We've used all this material that we've learned so far to come up with the optimal capital structure. So to go back to our picture, if we have the debt equity ratio on our axis over here, the value over here, we are saying we can maximize the value of our firm at a certain level of debt, which is 500, yeah, over whatever the original 2 million minus the 500, yeah, over exactly. So 500,000 over 1 million, 1.5 million. Okay, so let's, yeah.
So won't we take the current equity?
Okay, so actually you're right. So strictly speaking, the debt equity ratio, strictly speaking, you're right. So they're almost the same, but strictly speaking, you take this. So you notice they're about the same. Yeah, but the more precise thing is to use this. So the debt equity ratio that we have over here is 500 divided by
70-30.
Exactly. So this is giving you your optimal capital structure. So that asterisk over there corresponds to this point. Which two? Okay, so the question is, what's the difference between 1589 and 1500? The difference is that what's happening here is because the company is becoming more valuable as you take on more debt, the benefit of that additional value is going to the shareholders. So this is reflecting the fact. Notice the 89, what was the original value of the company? Yeah, 2 million. So are you making the company more valuable by taking on debt initially? Who benefits from that additional value? The shareholders, because debt holders are just getting their interest. So this is that additional value that is all going in the pockets of the shareholders. In the exam and later on, if this comes useful in life, you take on this value. Had this been if you subscribe to Modigliani and Miller's first theory with no taxes, then this would have been 1500, and then this analysis would not have been useful because the value would have been flat regardless. Okay, so I am going to take a 5-minute break. I've been speaking non-stop for the last 2.5 hours. Okay, so those who want to stay here can stay here, take a break, come back after 5 minutes, can come back after 5 minutes. Those who want to just leave can leave and listen to this later. Okay, so now what if we calculate the earnings per share at the different levels of debt, assuming that the firm begins at zero debt and recapitalizes to each level in a single step. Okay, so at every level of debt we calculate our net income using this process that we've talked about. Is the net income the same as the dividend?
Yes.
It is, because we are saying that the payout ratio is 100% or retention ratio is 0. Okay, so if this is the net income, how do you calculate your earnings per share? It's the net income divided by total number of shares. So when you have zero debt, our net income was 300. So this was simply the 500,000 minus 40% taxes. Initially we had 100,000 shares. So our EPS is 300,000 divided by 100,000, which is $3 per share. When we took on debt equal to 250 million, then net income became 285. The number of shares we calculated earlier was 87.85, and the EPS goes up. Good news? Yeah, so we are happy. Okay, so that's good news. As the debt keeps going up, the EPS goes up. Now here is the kicker. As you go to 750, it increases even more.
So
Okay.
the stock price is decreasing.
Yeah, brilliant. So where was the stock price max?
500.
The stock price was max. And now this highlights an important point. Are you trying to maximize EPS or are you trying to maximize stock price? Yeah, you need to maximize the total value of a company. So shareholders are more concerned with the value of their share or the EPS? Yeah. Do you own a share? Do you own any shares? Okay, then you buy some shares. I can assure you, you will be way more concerned with the price of the share rather than the earnings per share of the underlying of the company. Okay, you also, once you buy some shares, then you will know exactly why. Go ask your parents if they own shares. Ask them the share price, they'll probably know. Ask them whether they would prefer that the share price, if they own, let's say, 4G fertilizer, would they prefer that the share price goes up from 150 to 200, or would they prefer that the EPS goes from 3.8 to 3.9? What do you think they'll prefer? Any logical investor would have an eye on the share price. Most investors don't even know what the EPS is. Okay, so as managers, do you want to maximize EPS or do you want to maximize value of the share? You want to maximize the value of the share. So what this illustrates is that while in general EPS and value of the share might go up together, but that's not always the case. Okay, so at times the two might diverge, in which case obviously you are focused on maximizing the value of the company, i.e. value of the share. So this is just illustrated. EPS continues to increase beyond the 500,000 optimal debt level. Does this mean that the optimal debt level is this? No, because maybe EPS goes up even more beyond this debt level, but that is not the optimal debt level. The optimal debt level is where the value of the company or the share price is maximized. You can go home and do the calculation. So you can take on more debt and you can see what happens to the EPS. Obviously, as you are taking on more and more debt and the number of shares goes down, that will make the EPS go up, but the riskiness of those earnings become high, so the value of the firm might not go up. Okay, so now in case you were wondering where did WACC go, here it is. So you compute just logically and intuitively. If I make a global statement before making you focus on these numbers, so I make a larger statement that the value of a firm is maximized when the cost of financing represented by WACC is minimized. So I'm making that statement and I'm telling you it's a true statement. The value of a firm is maximized when WACC is minimized. Okay, so and to prove that we can look at the numbers. What's the WACC when we have 100% equity financing? So WACC is the same as the cost of equity because all our financing is coming through equity. As we take on more debt, what happens to what happens? So WACC comes down. So why is WACC coming down? Because notice that even though the cost of equity is going up, but we have the cost of debt which is also kicking in now. So cost of debt is 10%. On a after-tax basis, the cost of debt is even lower, and even though the relative weightage of debt is low, but still it is cost of debt is low, so the weighted average cost of capital comes below 15%. And at a debt of 500, the WACC comes down to 14.4. And as we then increase our debt further, notice that WACC now starts going up. So again, hammering in the fundamental point, the value of a firm is maximized when WACC is minimized. So exactly. So at the optimal capital structure, value will be maximum and WACC will be minimum. So the two sides of the same coin. Okay. Do you know how to calculate the WACC? Like, would you easily be able to calculate this WACC?
Yes.
If this shows up on the exam, will you say, sir, this was from an older chapter in the last reading, or will you recognize that that's fundamental to what you are doing now? So you are looking at the debt equity ratio. So this is easy, right? You've done this before. Okay, WACC is minimized at debt equal to 500,000, the same debt level that maximizes the stock price. Since the value of a firm is the present value of future operating income, the lowest discount rate leads to the highest value. How would higher or lower business risk impact the optimal capital structure? At any debt level, the firm's probability of financial distress would be higher. Okay. So actually a better way of stating this would be, as a firm takes on more debt, the chances of financial distress or the probability of financial distress becomes higher. Both cost of debt and cost of equity would rise faster than before. So the point is, as you are taking on more and more debt, the costs will start rising. The way you can think of this is, when you go from zero debt to 250,000 debt, the cost of equity will go up, but by a little bit, because people, when you go from zero debt to say 250,000 debt, you have taken on a little bit of debt. Do you have more financial risk?
Yes.
Yeah, but a little bit more, because if you are just taking now 20% of your capital structure as debt, do you think all the people around you, customers, suppliers, bankers, etc., would they worry a lot? No. So there is some worry, but little worry. As you keep taking on more debt, every additional 250 that you take, the incremental worry becomes more and more. Okay, does that point make sense? That's what's so both KD, the cost of debt, and cost of equity would rise at a faster rate as you take on more debt. So the end result would be that you have some optimal capital structure. And this is just hammering in an earlier point that initially, as you take on more debt, value goes up because the benefit of that debt is more than the cost. But if you keep doing that, you get to a point where the cost of taking on more debt is more than the benefit. Okay. Now a lower business risk would have a opposite effect. So this is just making a larger point that if you have two companies operating in two different industries, in one industry the business risk is relatively low. And how can we depict that in practical terms? If a company is operating in a very stable industry, so in the US context you talk about a company that is selling some staple goods such as cereal, or in our country a company that is selling say bread or wheat or things like that. So those companies will have very stable earnings. So such companies can take on a little more risk. Whereas companies that are operating in a very volatile market, companies that are selling cars, for example, or selling other luxury goods, where the demand is very cyclic, depends on the economy, such companies should take on or have the capacity to take on less risk or less debt. Yeah, it depends. Obviously, beta of companies that are operating in a very cyclic industry will tend to have higher beta. So higher beta companies should then be cautious about debt, take lower debt. Okay, so you notice that energy companies and big power companies that have very stable earnings can take on more debt. So the summary of that is, if your business risk is low, then you can take on more debt. If your business risk itself is high, then you should not be taking on much debt. Is it possible to do an analysis exactly like the one that we've done here for most firms? Now, this was a theoretical example to just illustrate some core points, so you can use this, but this analysis made several very basic assumptions. So it was based on the assumption of zero growth, which doesn't, as in most companies, grow at some rate. So can you change this model and assume some growth? You could. So after, when you have time, you can go back, create an Excel spreadsheet. It will be complicated. So that's why we didn't, there were enough complications here already, so we did not add this complication. But if you, no, not on the exam, but if you really want to learn and want to build something and do this, yeah, you can do it on Excel. Okay, so this is doable. Okay, it would be very difficult, if not impossible, to estimate KS. So KS also we've estimated, but the estimation is not always easy. What type of analysis should firms conduct to help them figure out the optimal or target capital structure? So you can create financial forecasting models that show you how different capital structure changes are likely to affect stock prices, coverage ratios, and so on. So this is, you're not likely to be tested in detail on this. All this is doing is giving you the realization that in the real world, what we are learning here is just the foundation, and the models that are built use these concepts but add a lot more detail. Forecasting models can generate results under various scenarios, but the financial manager must specify appropriate inputs. So you can have the most complex models in the world, but if you are feeding in garbage, you will get out garbage. So smart managers use good models, but those good models are only useful if you give realistic and proper inputs into the model. In the end, capital structure decisions are based on a combination of analysis, that's the 20 to 30% science that I talked about, and then there is a lot of judgment involved, that's the art or the experience part. Okay, so what other factors should managers consider when coming up with your capital structure? You can look at what else is happening in the industry. So if you are in an industry with very low debt ratios, then you should not try to be overly ambitious and have high ratios. Pro forma coverage ratios at different capital structures. Coverage ratios are these interest coverage ratios or time interest earned ratios. So this is your profits, or let's say EBIT divided by your interest. So do you want these ratios to be high or low? You want in general, you are safer if interest is low and EBIT is high. So in general, you are better off if these ratios are high. So generally, when banks or other institutions lend money to you, among other ratios, they look at this ratio. If you are a bank and you look at a company with a very low coverage ratio, would you worry? You would worry, because that means that their EBIT is relatively low relative to their interest expenses. So then it might be difficult for you to raise funding. So as a company, you want to also keep an eye on this. Okay, you also need to be aware of what sort of a rating you are getting from rating agencies such as Moody's and S&P and so on, because what does that impact? That impacts your cost of debt. Okay, and then some other general points. What is your borrowing capacity? You don't want to be maxed out on your borrowing capacity. Reserve borrowing capacity means that companies should have some debt, but should have the ability to take on more debt if some sort of an emergency arises. If you are already maxed out on debt and then an emergency happens, then you will be stuck. Okay, that's on, like in the dagger analogy, that's if your dagger is already almost touching you. Okay, you don't want to be in that much debt, because if anything happens, there isn't much cushion.